See this gap right here? Notice there's an absence of one over here, but look at all the back and forth price action. So we have only sell side here offered. So that means the candle went through between this candle's low and this candle's high. It delivered on the downside. So it's sell side delivery. Inefficient in the form of buy side delivery. So it's offered here on this candle. Then the next candle, we open, trade down, rally back up, and close right here. Next candle opens, trades down, stops right inside that gap low, then sends it higher. This is a balanced price range. Balanced price ranges tend to either stop at their high or low or midpoint, or which will be consequent encroachment, midpoint of the gap. We can see that happening essentially here. So this extended through, we cut through candles to get to a narrative. The algorithm's going right back to this inefficiency. And the fact that we traded back and forth here, buy side, sell side has been offered. It left that range right here. If it ever comes back down into it, it's highly unlikely that we'll trade to the low of this gap again and through it. Now I'm going to teach you advanced gap theory. This gap right there is simply a fair value gap. It's a common gap. The market breaks lower, and we have this gap right here. This is a fair value gap in the form of a CIVI, just like this is, but this is a breakaway gap. What is it doing? It's breaking away from this important higher time frame high, and it's moving aggressive. So we have two times there's a shift in market structure that's bearish. This is a breakaway gap. Breakaway gaps must have some context as to why price should see. For instance, it's breaking away from a level that we would already anticipate. Okay, so it's a higher time frame weekly gap high. We've already been there on Monday, repelled lower. We created a short-term high prior to it here and then ran up to it there, and then it took that low out there, left the gap. That in itself is the 2022 model. Then it breaks again. Breakaway gaps tend to leave a portion of the gap unfilled. From this candle's low to this candle's high, it retraces all the way up into this level. So between these highs of these candles and that candle's low, there's a small portion that's left open. We would expect to see that. This return in here, you're expecting this portion to stay open. If it does, you want to see that happen anyway for your trade. But if it doesn't and it completely fills it in, that's not a breakaway gap. Then it may need to come back up and tap this one more time. So what I just taught you is how you navigate. But the context is it's running up here to get traders thinking it's going higher. It's qualified as a breakaway gap because it leaves and goes lower to another new low and leaves that portion open. At that time, we get real confident that it never will come back up to this level here, so we can drop our stop rate to that level there. And then we have this large gap here, these two down closed candles. So it's only trading back up into consequent encroachment of the 2-minute range of these two specific 1-minute candles. And it's a measuring gap. What's that mean? We can take this range and use it for projection. Standard fair value gaps, which are common gaps, they can be reclaimed or traded back to as resistance or support. The market trades back up to it here. Look at the bodies of the candles here. That's telling you what? The bodies tell you the story. The wicks do the damage. Reading price action naked with time and looking for these types of signatures here, the open and close of these two candles here are supporting the idea that this low of that inefficiency is being respected. And then price does what? It trades lower. Where does it trade to? Below the sell side here, but not some random level. If we take the high of that price swing and draw that Fibonacci all the way down to that candle's high right there. From high to low of the gap. Why this gap? Because this is the measuring gap. It's approximately half of a implied dealing range. Implied meaning we're looking for it to go lower, but we haven't seen price go there yet. We're not reacting, remember? We're predicting price. So the high here, draw that down to that candle's high right there. What that does is gives you a projection to a standard deviation of -1. The low comes in exactly at 4269.25. Folks, that is the daily low to the tick. See, gaps are just like a PDRA matrix. They have an hierarchy, okay? You have a breakaway gap. You have common gaps. Common gaps can be reclaimed. That means treated multiple times. Measuring gaps tend to leave a portion open, just like a breakaway gap. So if we're expecting it to go lower, it stands to reason that we expect it not to trade all the way up here. And if we're expecting it to be a measuring gap, guess what? We want to see it not go up there. And that confirms and qualifies it as a measuring gap. Then we can take the high, project it down to the low of the gap if we're bearish, and then get our standard deviations. But that standard deviation -1 has to be in agreement with moving below an old area of liquidity.